Tap Dancing to Work. Warren Buffett on Practically Everything, 1966 to 2012. A Fortune magazine book by Carol J. Loomis. Are Jimmy and Warren Buffett related? June 21, 1999. By Tyler Maroney.
We'll begin to answer this question of blood ties between the Oracle of Omaha and the Minstrel of Margaritaville by pointing out their similarities, which are haunting. Both play stringed instruments. Jimmy, a tropical guitar, Warren, a mean ukulele. I've probably had worse musicians in my band, jokes Jimmy. They've both cashed in on unlikely investments. Warren bet on furniture, insurance, and vacuum cleaners, and is now worth $35 billion. Jimmy bet on the illusion of a colada-drenched beach bum and forged a multi-million-dollar brand with over 30 albums, 8 movies, a clothing line, nightclubs, a custom record label, 3 best-selling novels, and hundreds of gift shop gimmicks. Jimmy's a Capricorn, adept at accumulating money. Warren's a Virgo, with a creative musical mind. Both keep it real by sticking to what they know. Warren by avoiding tech stocks, Jimmy by milking a song he recorded more than a generation ago. Both attract cult followings. Parrot heads flock to Jimmy's summer concerts. Investors flock to Warren's Berkshire Hathaway shareholder meetings. Warren himself calls it the capitalist's Woodstock. Both avoid changes in latitudes and changes in attitudes. Warren's a die-hard Husker. Jimmy's still wasting away in mythical Margaritaville. Lethargy bordering on sloth is how Buffett describes the cornerstone of his style. That's Warren on investing, not Jimmy on chilling. In his classic Cheeseburger in Paradise, Jimmy croons, "Heaven on earth with an onion slice." Hamburgers are Warren's favorite food. But really, are they related? Fortune believes, but cannot prove beyond a doubt, that Warren and Jimmy are kin. It was Warren's sister Doris, the family genealogist, who first raised the subject. 2 years after mailing out questionnaires to all 125 Buffetts in the U.S., she got a call from a curious Jimmy. He said, "I want to be related to your family because they're rich and famous." Doris recalls, and I said, "That's funny. We want to be related to you because you're rich and famous." Doris's research has unearthed 3 possible ancestral links. John Buffett, a poor 17th century pickle farmer from Long Island, a Newfoundland sailor whom Jimmy honors in Son of a Sailor, and Norfolk Island in the South Pacific, which is inhabited by hundreds of Buffetts, as well as a good many descendants of the mutineers of the Bounty. When Doris and Jimmy discovered that Norfolk Island used to be a penal colony, however, they lost hope. Centuries of inbreeding have blurred family lines. Despite the lack of absolute proof that they're related, as of press time, no DNA testing has been conducted. Warren and Jimmy have become friends. While Jimmy insists Uncle Warren doesn't slip him any investing tips, the two have been known to break out in song. "I think he's angling to get into my will," the billionaire Buffett jokes. "But the way things are going, I'd rather be in his."
And the final answer is 8 years and many scientific advances later, Jimmy and Warren did the requisite spitting into small receptacles and submitted to a DNA analysis, carried out by 23andMe, a company co-founded by Anne Wojcicki, who happens to be the wife of Google co-founder Sergey Brin. The results showed, alas, that Jimmy and Warren are not related. To find common ancestors for the two, you'd have to go back 10,000 years, which is before surnames, and that doesn't count. Case closed. CL. Put Byte into audit committees. August 2, 1999. by Carol Loomis. In the days before Sarbanes-Oxley became law, regulators struggled to end cooking the books, and Buffett weighed in on the issue. C.L. Eager for boards to have better audit committees than they do, Arthur Levitt got a special panel to make recommendations for improvement and now wants them adopted. But when the New York Stock Exchange asked its listed companies to comment on the recommendations, back came bullets. The companies especially disliked a proposal that would have required audit committees to do their homework and then attest in annual reports that the financial statements therein conformed to GAAP. Some protesters thought such a rule would invite lawsuits against audit committee members. Others saw role confusion. Attesting, said one letter, is what the external auditor is hired to do. A related objection came from Warren Buffett, who, up to the minute he put up his hand on this one, had publicly and warmly applauded Levitt's campaign against earnings management. Here, though, Buffett disputed the thought that an audit committee, meeting for a few hours a year, could attest to anything meaningful about a company's financial statements. Instead, he said, the committee needs to learn what the outside auditors know, something that frequently does not occur, even, perhaps especially, when major shortcomings exist. Buffett said the committee should require the auditors to give detailed answers to 3 questions. 1. If the auditor were solely responsible for preparation of the company's financial statements, would they have been done differently, in either material or non-material ways? If differently, the auditor should explain both management's argument and his own. 2. If the auditor were an investor, would he have received the information essential to understanding the company's financial performance during the reported period? 3. Is the company following the same internal audit procedure the auditor would if he himself were CEO? If not, what are the differences and why? Buffett then said, in italics, that the auditor's answers should be spelled out in the minutes of the meeting. The point, he said, is to hang monetary liability on the auditors, that being the only thing that will drive them to truly do their job instead of becoming subservient to management. Fortune asked Olivia Kirtley, chair of the American Institute of Certified Public Accountants and also chief financial officer of Vermont American Corporation, for her opinion about Buffett's ideas. He'd boiled down his questions, she said, but they were in the spirit of what the AICPA's own audit committee asks of its outside auditors. Whether her auditing firm constituency would like a plan that seeks to get them either to do their job well or to accept monetary responsibility for failure is doubtful. Auditors have eased their legal troubles in the past decade, managing to establish that financial statements are the responsibility of management, and also getting help from new laws and a friendly Supreme Court decision. As a result, the number of suits auditors are having to defend is sharply down. Of course, it is also during this decade that managements have learned all the subterranean routes for meeting expectations. Is that simply coincidence, or has the slimming of monetary consequences made auditors less diligent and more compliant than was once the case? That question is unanswerable. Buffett's 3 are not. Mr. Buffett on the Stock Market, November 22, 1999. A Buffett speech that Carol Loomis converted into an article. Warren Buffett almost never talks publicly about the general level of stock prices, neither in his famed annual report, nor at Berkshire's thronged annual meetings, nor in the rare speeches he gives. But in the last half of 1999, on 4 occasions, Buffett did step up to that subject, laying out his opinions, in ways both analytical and creative, about the long-term future for stocks. I heard the last of those talks, given in September to a group of Buffett's friends, and also watched a videotape of the first speech, given in July at Allen & Company's Sun Valley, Idaho Bash for Business Leaders. From those extemporaneous talks, the first made with the Dow Jones Industrial Average at 11,194, I distilled the following account of what Buffett said. Buffett reviewed it and weighed in with some clarifications. Buffett's central message is contained in the first words of this article. Investors in stocks these days are expecting far too much. As for the nascent Internet, whose promise swelled investors' hopes, he proceeded to emphasize how few people got rich from two other transforming industries, auto and aviation. In his speeches, Buffett certainly did not anticipate the low interest rates, Treasury bills that pay pennies, for example, prevailing currently. Neither was he quite as grim about stock market returns as reality has proved them to be. But he was absolutely right in his general bearishness about the market, so much so that he says today, "I wouldn't change a word of what I said." He was speaking at a time when investors had grown used to an average annual total return of 12% on their holdings. He expected instead that 7% was a reasonable estimate as to what investors, before inflation, could earn annually in total returns over the 17 years from 1999 to 2016. The article explains why he selected that oddball number of years. And that was a gross figure, before the heavy transactional costs that investors bear, commissions, sales loads, and management fees, for example. After these costs, Buffett thought that a reasonable expectation for the return would be about 6% annually. In lamentable fact, the total return of the Dow Industrials, compounded annually, was from the end of 1999 through mid-2012 only 3.32%. The comparable figure for the S&P 500, which is not as dividend-heavy as the Dow and suffered much more than the Dow when the Internet bubble burst, was absolutely abysmal, 1.26%. As this book is published, there are still 4 years to go, of course, before the 17 years end. But they will have to deliver superb results if investors are to speed across the ground they've lost and end up with even a 6% annual total return. C.L.
Investors in stocks these days are expecting far too much, and I'm going to explain why. That will inevitably set me to talking about the general stock market, a subject I'm usually unwilling to discuss, but I want to make one thing clear going in. Though I will be talking about the level of the market, I will not be predicting its next moves. At Berkshire, we focus almost exclusively on the valuations of individual companies, looking only to a very limited extent at the valuation of the overall market. Even then, valuing the market has nothing to do with where it's going to go next week, or next month, or next year, a line of thought we never get into. The fact is that markets behave in ways, sometimes for a very long stretch, that are not linked to value. Sooner or later, though, value counts. So what I'm going to be saying, assuming it's correct, will have implications for the long-term results to be realized by American stockholders. Let's start by defining investing. The definition is simple, but often forgotten. Investing is laying out money now to get more money back in the future. More money in real terms after taking inflation into account. Now, to get some historical perspective, let's look back at the 34 years before this one. And here we are going to see an almost biblical kind of symmetry in the sense of lean years and fat years to observe what happened in the stock market. Take, to begin with, the first 17 years of the period, from the end of 1964 through 1981. Here's what took place in that interval. Dow Jones Industrial Average, December 31st, 1964, 874.12. December 31st, 1981, 875.0. Now, I'm known as a long-term investor and a patient guy, but that is not my idea of a big move. And here's a major and very opposite fact. During the same 17 years, the GDP of the U.S., that is, the business being done in this country, almost quintupled, rising by 370%. Or if we look at another measure, the sales of the Fortune 500, a changing mix of companies, of course, more than sextupled, and yet the Dow went exactly nowhere. To understand why that happened, we need first to look at one of the two important variables that affect investment results: interest rates. These act on financial valuations the way gravity acts on matter. The higher the rate, the greater the downward pull. That's because the rates of return that investors need from any kind of investment are directly tied to the risk-free rate that they can earn from government securities. So, if the government rate rises, the prices of all other investments must adjust downward to a level that brings their expected rates of return into line. Conversely, if government interest rates fall, the move pushes the prices of all other investments upward. The basic proposition is this: what an investor should pay today for a dollar to be received tomorrow can only be determined by first looking at the risk-free interest rate. Consequently, every time the risk-free rate moves by 1 basis point, by 0.01%, the value of every investment in the country changes. People can see this easily in the case of bonds, whose value is normally affected only by interest rates. In the case of equities or real estate or farms or whatever, other very important variables are almost always at work, and that means the effect of interest rate changes is usually obscured. Nevertheless, the effect, like the invisible pull of gravity, is constantly there. In the 1964 to 81 period, there was a tremendous increase in the rates on long-term government bonds, which moved from just over 4% at year-end 1964 to more than 15% by late 1981. That rise in rates had a huge depressing effect on the values of all investments. But the one we noticed, of course, was the price of equities. So there, in that tripling of the gravitational pull of interest rates, lies the major explanation of why tremendous growth in the economy was accompanied by a stock market going nowhere. Then, in the early 1980s, the situation reversed itself. You will remember Paul Volcker coming in as chairman of the Fed, and remember also how unpopular he was. But the heroic things he did, his taking a 2x4 to the economy and breaking the back of inflation, caused the interest rate trend to reverse, with some rather spectacular results. Let's say you put $1 million into the 14% 30-year U.S. bond issued November 16, 1981, and reinvested the coupons. That is, every time you get an interest payment, you use it to buy more of that same bond. At the end of 1998, with long-term governments by then selling at 5%, you would have had $8,181,219 and would have earned an annual return of more than 13%. That 13% annual return is better than stocks have done in a great many 17-year periods in history. In most 17-year periods, in fact. It was a hell of a result, and from none other than a stodgy bond. The power of interest rates had the effect of pushing up equities as well, though other things that we will get into pushed additionally. And so here's what equities did in that same 19 years. If you'd invested $1 million in the Dow on November 16, 1981, and reinvested all dividends, you'd have had $19,720,112 on December 31st, 1998, and your annual return would have been 19%. The increase in equity values since 1981 beats anything you can find in history. This increase even surpasses what you would have realized if you'd bought stocks in 1932 at their Depression bottom. On its lowest day, July 8, 1932, the Dow closed at 41.22 and held them for 17 years. The second thing bearing on stock prices during this 17 years was after-tax corporate profits. I'm quite fond of 1929, since that's when it all began for me. My dad was a stock salesman at the time, and after the crash came in the fall, he was afraid to call anyone, all those people who'd been burned, so he just stayed home in the afternoon. And there wasn't television then, so I was conceived on or about November 30th, 1929, and born 9 months later on August 30th, 1930. And I've forever had a kind of warm feeling about the crash. Corporate profits as a percentage of GDP peaked in 1929, and then they tanked. In fact, the years from 1929 to 1950 were filled with aberrations. Not only the Depression, but also a wartime profits boom, sedated by the excess profit tax, and another boom after the war. But from 1951 on, the percentage settled down pretty much to a 4% to 6.5% range. By 1981, though, the trend was headed toward the bottom of that band, and in 1982, profits tumbled to 3.5%. So at that point, investors were looking at two strong negatives. Profits were subpar, and interest rates were sky high. And as is so typical, investors projected out into the future what they were seeing. That's their unshakable habit, looking into the rear view mirror instead of through the windshield. What they were observing, looking backward, made them very discouraged about the country. They were projecting high interest rates. They were projecting low profits. They were therefore valuing the Dow at a level that was the same as 17 years earlier, even though GDP had nearly quintupled. Now, what happened in the 17 years beginning in 1982? One thing that didn't happen was comparable growth in GDP. In this second 17-year period, GDP less than tripled, but interest rates began their descent, and after the Volcker effect wore off, profits began to climb, not steadily, but nonetheless with real power. By the late 1990s, after-tax profits as a percent of GDP were running close to 6%, which is on the upper part of the normalcy band. And at the end of 1998, long-term government interest rates had made their way down to that 5%. These dramatic changes in the two fundamentals that matter most to investors explain much, though not all, of the more than tenfold rise in equity prices. The Dow went from 875 to 9,181 during this 17-year period. What was at work also, of course, was market psychology. Once a bull market gets underway, and once you reach the point where everybody has made money, no matter what system he or she followed, a crowd is attracted into the game that is responding not to interest rates and profits, but simply to the fact that it seems a mistake to be out of stocks. In effect, these people superimpose an I can't miss the party factor on top of the fundamental factors that drive the market. Like Pavlov's dog, these investors learn that when the bell rings, in this case the one that opens the New York Stock Exchange at 9:30 a.m., they get fed. Through this daily reinforcement, they become convinced that there is a God and that He wants them to get rich. Today, staring fixedly back at the road they just traveled, most investors have rosy expectations. A Paine-Webber and Gallup organization survey released in July shows that the least experienced investors, those who have invested for less than 5 years, expect annual returns over the next 10 years of 22.6%. Even those who have invested for more than 20 years are expecting 12.9%. Now, I'd like to argue that we can't come even remotely close to that 12.9% and make my case by examining the key value-determining factors. Today, if an investor is to achieve juicy profits in the market over 10 years or 17 or 20, one or more of 3 things must happen. I'll delay talking about the last of them for a bit, but here are the first 2. 1. Interest rates must fall further. If government interest rates, now at a level of about 6%, were to fall to 3%, that factor alone would come close to doubling the value of common stocks. Incidentally, if you think interest rates are going to do that, or fall to the 1% that Japan has experienced, you should head for where you can really make a bundle: bond options. 2. Corporate profitability in relation to GDP must rise. You know, someone once told me that New York has more lawyers than people. I think that's the same fellow who thinks profits will become larger than GDP. When you begin to expect the growth of a component factor to forever outpace that of the aggregate, you get into certain mathematical problems. In my opinion, you have to be wildly optimistic to believe that corporate profits as a percent of GDP can, for any sustained period, hold much above 6%. One thing keeping the percentage down will be competition, which is alive and well. In addition, there's a public policy point. If corporate investors, in aggregate, are going to eat an ever-growing portion of the American economic pie, some other group will have to settle for a smaller portion. That would justifiably raise political problems, and in my view, a major reslicing of the pie just isn't going to happen. So, where do some reasonable assumptions lead us? Let's say that GDP grows at an average 5% a year, 3% real growth, which is pretty darn good, plus 2% inflation. If GDP grows at 5%, and you don't have some help from interest rates, the aggregate value of equities is not going to grow a whole lot more. Yes, you can add on a bit of return from dividends, but with stocks selling where they are today, the importance of dividends to total return is way down from what it used to be. Nor can investors expect to score because companies are busy boosting their pet share earnings by buying in their stock. The offset here is that the companies are just about as busy issuing new stock, both through primary offerings and those ever-present stock options. So I come back to my postulation of 5% growth in GDP and remind you that it is a limiting factor in the returns you're going to get. You cannot expect to forever realize a 12% annual increase, much less 22%, in the valuation of American business if its profitability is growing only at 5%. The inescapable fact is that the value of an asset, whatever its character, cannot over the long term grow faster than its earnings do. Now, maybe you'd like to argue a different case, fair enough. But give me your assumptions. If you think the American public is going to make 12% a year in stocks, I think you have to say, for example, well, that's because I expect GDP to grow at 10% a year, dividends to add 2% points to returns, and interest rates to stay at a constant level. Or you've got to rearrange these key variables in some other manner. The Tinkerbell approach, clap if you believe, just won't cut it. Beyond that, you need to remember that future returns are always affected by current valuations and give some thought to what you're getting for your money in the stock market right now. Here are two 1998 figures for the Fortune 500. The companies in this universe account for about 75% of the value of all publicly owned American businesses. So when you look at the 500, you're really talking about America, Inc. Fortune 500. 1998 profits, $334,335,000,000. Market value on March 15th, 1999, $9,907,233,000,000. As we focus on those two numbers, we need to be aware that the profits figure has its quirks. Profits in 1998 included one very unusual item, a $16 billion bookkeeping gain that Ford reported from its spin-off of Associates. And profits also included, as they always do in the 500, the earnings of a few mutual companies such as State Farm that do not have a market value. Additionally, one major corporate expense, stock option compensation costs, is not deducted from profits. On the other hand, the profits figure has been reduced in some cases by write-offs that probably don't reflect economic reality and could just as well be added back in. But leaving aside these qualifications, investors were saying on March 15th this year that they would pay a hefty $10 trillion for the $334 billion in profits. Bear in mind, this is a critical fact often ignored, that investors as a whole cannot get anything out of their businesses except what the businesses earn. Sure, you and I can sell each other stocks at higher and higher prices. Let's say the Fortune 500 was just one business and that the people in this room each owned a piece of it. In that case, we could sit here and sell each other pieces at ever-ascending prices. You personally might outsmart the next fellow by buying low and selling high. But no money would leave the game when that happened. You'd simply take out what he put in. Meanwhile, the experience of the group wouldn't have been affected a whit, because its fate would still be tied to profits. The absolute most that the owners of a business in aggregate can get out of it in the end, between now and Judgment Day, is what the business earns over time. There's still another major qualification to be considered. If you and I were trading pieces of our business in this room, we could escape transactional costs because there would be no brokers around to take a bite out of every trade we made. But in the real world, investors have a habit of wanting to change chairs, or at least getting advice as to whether they should, and that costs money, big money. The expenses they bear, I call them frictional costs, are for a wide range of items. There's the market maker's spread and commissions and sale loads and the 12B1 fees and management fees and custodial fees and wrap fees and even subscriptions to financial publications. And don't brush these expenses off as irrelevancies. If you were evaluating a piece of investment real estate, would you not deduct management costs in figuring your return? Yes, of course. And in exactly the same way, stock market investors who are figuring their returns must face up to the frictional costs they bear. And what do they come to? My estimate is that investors in American stocks pay well over $100 billion a year, say $130 billion, to move around on those chairs or to buy advice as to whether they should. Perhaps $100 billion that relates to the Fortune 500. In other words, investors are dissipating almost a third of everything that the Fortune 500 is earning for them, that $334 billion in 1998, by handing it over to various types of chair-changing and chair advisory helpers. And when that handoff is completed, the investors who own the 500 are reaping less than a $250 billion return on their $10 trillion investment. In my view, that's slim pickings. Perhaps by now you're mentally quarreling with my estimate that $100 billion flows to those helpers. How do they charge thee? Let me count the ways. Start with transaction costs, including commissions, the markers makers take, and the spread on underwritten offerings. With double counting stripped out, there will this year be at least 350 billion shares of stock traded in the U.S., and I would estimate that the transaction cost per share for each side, that is, for both the buyer and the seller, will average 6 cents. That adds up to $42 billion. Move on to the additional costs. Hefty charges for little guys who have wrap accounts, management fees for big guys, and, looming very large, a raft of expenses for the holders of domestic equity mutual funds. These funds now have assets of about $3.5 trillion. And you have to conclude that the annual cost of these to their investors, counting management fees, sales loads, 12b-1 fees, general operating costs, runs to at least 1% or $35 billion. And none of the damage I've so far described counts the commissions and spreads on options and futures, or the costs borne by holders of variable annuities, or the myriad other charges that the helpers manage to think up. In short, $100 billion of frictional costs for the owners of the Fortune 500, which is 1% of the 500's market value, looks to me not only highly defensible as an estimate, but quite possibly on the low side. It also looks like a horrendous cost. I once heard about a cartoon in which a news commentator says, "There's no trading on the New York Stock Exchange today. Everyone was happy with what they owned." Well, if that were really the case, investors would every year keep around $130 billion in their pockets. Let me summarize what I've been saying about the stock market. I think it's very hard to come up with a persuasive case that equities will over the next 17 years perform anything like they've performed in the past 17. If I had to pick the most profitable return from appreciation and dividends combined that investors in aggregate, would earn in a world of constant interest rates, 2% inflation, and those ever hurtful frictional costs, it would be 6%. If you strip out the inflation component from this nominal return, which you would need to do however inflation fluctuates, that's 4% in real terms. And if 4% is wrong, I believe that the percentage is just as likely to be less as more. Let me come back to what I said earlier, that there are 3 things that might allow investors to realize significant profits in the market going forward. The first was that interest rates might fall. The second was that corporate profits as a percent of GDP might rise dramatically. I get to the third point now. Perhaps you are an optimist who believes that though investors as a whole may slog along, you yourself will be a winner. That thought might be particularly seductive in these early days of the information revolution, which I wholeheartedly believe in. Just pick the obvious winners, your broker will tell you, and ride the wave. Well, I thought it would be instructive to go back and look at a couple of industries that transformed this country much earlier in the century: automobiles and aviation. Take automobiles first. I have here 1 page out of 70 in total of car and truck manufacturers that have operated in this country. At one time, there was a Berkshire car and an Omaha car. Naturally, I noticed those, but there was also a telephone book of others. All told, there appear to have been at least 2,000 car makes in an industry that had an incredible impact on people's lives. If you had foreseen in the early days of cars how this industry would develop, you would have said, "Here is the road to riches." So what did we progress to by the 1990s? After corporate carnage that never let up, we came down to 3 U.S. car companies themselves, no lollapaloozas for investors. So here is an industry that had an enormous impact on America, and also an enormous impact, though not an anticipated one, on investors. Sometimes, incidentally, it's much easier in these transforming events to figure out the losers. You could have grasped the importance of the auto when it came along, but still found it hard to pick companies that would make you money. But there was no one obvious decision you could have made back then. It's better sometimes to turn these things upside down. And that was to short horses. Frankly, I'm disappointed that the Buffett family was not short horses through this entire period. And we really have no excuse. Living in Nebraska, we would have found it super easy to borrow horses and avoid a short squeeze. U.S. horse population, 1900, 21 million. 1998, 5 million. The other truly transforming business invention of the first quarter of the century, besides the car, was the airplane. Another industry whose plainly brilliant future would have caused investors to salivate. So I went back to check out aircraft manufacturers and found that in the 1919 to 39 period, there were about 300 companies, only a handful still breathing today. Among the planes made then, we must have been the Silicon Valley of that age, where both the Nebraska and the Omaha, 2 aircraft that even the most loyal Nebraskan no longer relies upon. Move on to failures of airlines. Here, says Buffett in his speech, waving a piece of paper, is a list of 129 airlines that in the past 20 years filed for bankruptcy. Continental was smart enough to make that list twice. As of 1992, in fact, though the picture would have improved since then, the money that had been made since the dawn of aviation by all of this country's airline companies was zero. Absolutely zero. Sizing all this up, I'd like to think that if I'd been at Kitty Hawk in 1903 when Orville Wright took off, I would have been farsighted enough and public-spirited enough, I owed this to future capitalists, to shoot him down. I mean, Karl Marx couldn't have done as much damage to capitalists as Orville did. I won't dwell on other glamorous businesses that dramatically changed our lives, but concurrently failed to deliver rewards to U.S. investors, the manufacture of radios and televisions, for example. But I will draw a lesson from these businesses. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors. This talk of 17-year periods makes me think, incongruously I admit, of 17-year locusts. What could a current brood of these critters, scheduled to take flight in 2016, expect to encounter? I see them entering a world in which the public is less euphoric about stocks than it is now. Naturally, investors will be feeling disappointment, but only because they started out expecting too much. Grumpy or not, they will have by then grown considerably wealthier simply because the American business establishment that they own will have been chugging along, increasing its profits by 3% annually in real terms. Best of all, the reward from this creation of wealth will have flowed through to Americans in general, who will be enjoying a far higher standard of living than they do today. That wouldn't be a bad world at all, even if it doesn't measure up to what investors got used to in the 17 years just past.
Warren Buffett, Revivalist, May 19, 2000, by Amy Cover. Berkshire Hathaway chairman Warren Buffett calls his annual shareholders' meeting the Woodstock Weekend for Capitalists. But investor Michael Cleveland has a better analogy. It's a religious revival, and Buffett is our evangelist. For years, shareholders have flocked to Omaha each spring to hear Buffett preach the virtues of investing in and holding on to strong, proven businesses. As the incredible returns piled up, so have conversions to Buffettism. But last year, Buffett seemed to have lost his heavenly touch. This year, Berkshire's per-share book value underperformed the S&P 500 index by 20.5 percentage points. The first time in 20 years it lagged the index. The problem? Most of Buffett's blessed stocks, including Coca-Cola and Gillette, tumbled. Meanwhile, infant net stocks soared, making many instant millionaires. Buffett still refused to jump in. He doesn't feel comfortable betting on companies and industries subject to great uncertainties. Berkshire Hathaway fell 50% to a 52-week low of $40,800 a share by early March, enough to rattle the faith of even the most devout. Like any good revivalist, Buffett had a higher power on his side: Wall Street. Miraculously, his stock staged a 47% recovery to around $60,000 just in time for the meeting in late April. What's more, technology stocks tanked. "We're in this stock for the long haul anyway," notes Brian Goebel of Huntington Beach, California. "We're not day traders." Certainly not. Unlike the NouveauRiche.com clique, Buffett heads aren't glam. Rather than Prada slip dresses and Manolo Blahnik pumps, the weekend uniform was a forest green Berkshire t-shirt, emblazoned with a fistful of cash, and matching baseball cap. Few of the folks who lined up for free Danish and coffee looked as if they could afford a $60,000 share of Class A stock. This crowd was particularly pumped when Buffett announced that See's Candies, a company that Berkshire owns outright, was working in collaboration with Mattel to make a Barbie doll dressed in See's classic 1950s salesgirl outfit. Everyone clamored for order sheets. Of course, the weekend wasn't all about Barbies. The meat of the conference was the 7-hour meeting on Saturday in the cavernous Omaha Civic Auditorium. Buffett kicked off the event with a goofy 1-hour movie in which he strummed on a ukulele and played Who Wants to Be a Jillionaire with Regis Philbin. Sample question: what is the surefire investment for the new millennium? Buffett opted for a lifeline call to Bill Gates, after noting, value investing hasn't been working so hot lately. Then the gang settled down to business. For almost 5 hours, shareholders posed questions to Buffett and his vice chairman, Charlie Munger. Some shed their worshipful attitude, pressing Buffett on the company's underwhelming performance last year. One 15-year-old said, "I bought Class B shares 2 years ago for college. When they dipped below 1,500, I decided to investigate correspondence courses." Buffett laughed, as if to say, "You got me." Throughout the weekend, Omaha became a trade show floor showcasing Berkshire's wide-ranging businesses: International Dairy Queen, See's Candies, Dexter Shoe, and World Book. Shareholders scooped up discounted knives, mattresses, and diamonds with a hungry vengeance. On Saturday night, Buffett lured the faithful to a minor league baseball game, though many missed half the game waiting in line for Buffett's autograph. And others took part in their favorite pastime, trading Buffett tales. "Have you driven by his house?" one woman asked. "It's so modest." Another woman says she went to high school with the chairman. She had her photo taken with him at the last reunion. "I had a lot of boasting to do the next day," she laughed. Some had more pressing reasons to make the pilgrimage this year. Bong Zheng, who has owned Berkshire stock for a decade, needed to get back in touch with his Buffett values. It's been hard not to be tempted by internet stocks, explains Young. When you play golf, you chat about investing. My friend is telling me that he's making 80% in tech, while my stock is down 30%. It's hard not to be jealous. So I came here to renew my faith. Exactly, chimes in his wife. Renew. Once again, sage Buffett gave his minions something to believe in. Warren Buffett invests in the First Lady, October 20th, 2000, by Jeffrey Birnbaum. Warren Buffett, a Democrat through most of his adult life, has over the years supported many a party candidate. But he gained particular attention, as witness the article that follows, when he backed Hillary Clinton's successful bid in 2000 to be elected senator from New York. The plot thickened then, in 2008, as Senator Clinton sought to become the Democrats' candidate for president. That gave Buffett a certain problem, in that he had also developed a cordial relationship with another contender, Barack Obama. Through a friend, Buffett had met Obama earlier when the Chicagoan was preparing to run for senator from Illinois. Obama came to Omaha then for lunch and conversation. Buffett liked the young man and his views, and the two men parted friends. What to do in 2008 then, when Clinton and Obama were both seeking the Democratic nomination? Buffett resolved that question by making himself, in his jest, a political bigamist. That is, he told the candidates that he would back both of them, which indeed he did. And we know who won. C.L.
Warren Buffett started life as a Republican. He had all but inherited the preference from his father, a four-term Republican congressman from Nebraska. Buffett was so zealous that he was president of the Young Republicans Club at the University of Pennsylvania, and in 1948 planned to ride an elephant down a Philadelphia thoroughfare to celebrate the election of Thomas Dewey until Harry Truman defeated Dewey. How times have changed. Buffett these days is decidedly Democratic. He has even raised and given money to, of all people, Hillary Clinton. That's right. The sage of Omaha is putting his money on Clinton's bid to become a senator from New York. Buffett went to Columbia University to appear on the First Lady's behalf alongside former Treasury Secretary Robert Rubin. He also co-hosted fundraisers for her at the Russian Tea Room in Manhattan and at the Omaha home of Vin Gupta, CEO of Info USA. Has he lost his mind? Not at all. I support politicians, irrespective of party, when I think their ideas on important issues are largely in sync with my own, says Buffett, a registered Democrat. In this case, he likes Clinton's pro-choice position on abortion, and her backing of campaign finance reform, a pet project of his. Unlike some of Clinton's donors, Buffett has not slept over at the White House or Camp David. Not even on a couch, he notes. I support her ideas, it's that simple, Buffett says. It's the same reason I voted for her husband. He also has a special affinity for New York. His company, Berkshire Hathaway, owned the Buffalo News, and he says that what happens in the state has an effect well beyond its borders. The surprise is that Buffett gives money to politicians at all. He has pushed hard and publicly in recent years to reform campaign financing. He has focused his ire on the system's most flagrant abuse, so-called soft money, the unlimited contributions to political parties. To avoid being labeled as a hypocrite, Buffett donates only hard money to federal candidates, which is limited to $1,000 per election per candidate. In other words, he has given Clinton $2,000, $1,000 for the primary and $1,000 for the general election. Buffett also doesn't ask others to contribute to his chosen candidates. He says he wants people to donate because they believe in the aspirant, not because he asks them to. Still, the name Warren Buffett on a fundraising invitation is sure to draw a crowd, and he's been careful about which candidates to back. They've mostly been Democrats, including his friend Senator Bob Kerrey of Nebraska, and, for president, former New Jersey Senator Bill Bradley. He also supported such champions of campaign finance reform as Democratic Senator Russ Feingold of Wisconsin and Connecticut's Representative Chris Shays, a Republican. In years past, he backed such well-regarded lawmakers as GOP Senator Nancy Kasbaum of Kansas and Democratic Senator Daniel Patrick Moynihan, whose seat Clinton is fighting to win. "I think she's quite effective and articulate," Buffett says of Clinton. "If she's elected, she'll be more than 1 in 100. Does that mean the First Lady is an undervalued asset?
Admired again and again. Fortune publishes its list of the most admired companies every year, and this year, 2001, our editors plucked Berkshire and Buffett from its number 7 spot on the list to write about and feature on the cover. History and maybe foresight justified that. Berkshire had been in the top 10 of the most admired for 5 years, and has stayed ever since, even after Fortune merged its U.S. and global lists into one world list beginning in 2008. For the last 15 years, 1997 through 2012, Berkshire is the only company that has always made the top 10. Buffett loves it all. Having Berkshire finish high in a list ranked by revenues, as is the Fortune 500, where Berkshire has risen to the top 10, matters little to him. But he values a good reputation immensely. Talking to Fortune in 2010 about how a business earns trust, he said, "You can't do it in a day or week or month. You do it one grain of sand at a time, and you can destroy it fast, but you build it slowly." Being a perennial object of admiration does not rule out a company having operating problems, or perhaps flunking the best use of its assets. And this story, The Value Machine, talks about Berkshire's intractable difficulties with its main subsidiary, Dexter Shoe. Naturally, Buffett did not anticipate problems. He was, in fact, an enthusiastic acquirer when Berkshire bought the company in 1993, paying stock worth $419 million. But Buffett severely underestimated the low-cost overseas competition that Dexter was facing, and by the 1999 annual report was forced to acknowledge that things at the company were not good. In 2000, Berkshire wrote off $219 million of Dexter accounting goodwill, and the next year Buffett threw in the towel, conceding that he, A, shouldn't have bought Dexter in the first place, B, particularly shouldn't have bought it with stock, and C, had procrastinated in attacking its problems. The management of Dexter was turned over in 2001 to another Berkshire shoe company, whose managers, Frank Rooney and Jim Isler, reduced its business, amid plant shutdowns and layoffs, to a few operations. By 2005, the Dexter name had disappeared entirely from Berkshire's annual report. Today, Buffett says of Dexter, "This is definitely the worst acquisition I have ever made, so far." Harold Alfond, chairman and major owner of Dexter when Berkshire bought it, and a well-known philanthropist before and after, died in 2007 and left most of his fortune to the Harold Alfond Foundation. When his will was settled, the foundation's assets jumped 5-fold to $500 million, about 80% of that in Berkshire stock. The foundation principally gives to Maine education, medical, and youth development causes. So that is another example, a paradoxical one, of Berkshire wealth going to philanthropy. C.L. The Value Machine, February 19, 2001, by Carol Loomis. A small quiz, if you don't mind. Kindly describe what each of the companies in the top 10 of the most admired does. Most readers could breeze through 8 of these paragons. They're into megastores, Walmart, the securities brokerages, Schwab, and computer chips, Intel, and so on. General Electric is tougher to parse. It's financial services, but also a TV network, and an electrical equipment and aerospace empire, soon to include Honeywell. But the real puzzler is number 7, Berkshire Hathaway of Omaha. Using a sharp number 2 pencil, could you please write 500 words on that company's business? If you're like many people, you couldn't get past 4 of them. That's Warren Buffett's company. It would take a Berkshire groupie, of whom there are carloads, to elucidate the fine points. What we've got here is a highly unusual combination of a very profitable operating company, insurance in a big way, plus a crazy quilt of other businesses, and a CEO, now 70, who invests its money and who, in that department, has a strong, long-standing claim to being the best in the world. In the 36 years that Buffett has run the company, Berkshire's per-share book value, the performance statistic that best describes the success of an insurance company, has grown, on average, by more than 23% a year. There have been a couple of ugly lurches, notably a terrible year in 1999, but in 32 of the 36 years, Berkshire's per-share results have beaten the total return of the S&P 500, often by miles. Berkshire's stock, which Buffett wouldn't dream of splitting, he sends birthday greetings to friends that say, "May you live until Berkshire splits," has tracked the company's success and then some. In those same 36 years, it has gone from about $12 a share to a year-end price of $71,000, which is an annual growth rate of 27%. Famous though this record may be, even many of the business people who vote for the most admired don't understand the machinery behind Berkshire's value proposition. A few may not even connect with the fact that they're voting, lordy, for an insurance company. But clearly, they like something. This is the 5th straight year that Berkshire has made the top 10. We now interrupt this account for some disclosure. I'm an admirer too, and a longtime friend of Buffett's, and perennial editor of his annual report, though he's most certainly the writer, and a Berkshire shareholder for decades. Buffett and I have talked forever about collaborating on a book about his business career. In terms of words actually written, this has been all hat and no cattle, and as a result, I have had unusual access to his thinking. What I know at this moment is that Berkshire had a remarkable year in 2000, in ways largely unrecognized. I'm not talking about the stock, although that's what most Berkshire followers were looking at. While tech stocks were skyrocketing earlier in the year, Berkshire was tanking. It got all the way down to 40,800 in March, when, Buffett says, we were on that other list, the most admired by short sellers. The stock then came back to that $71,000, which, from the bottom, was a gain of 74%. In late January, the stock was $68,000. The rebound left Berkshire climbing 26.6 for the calendar year, in a down year for most companies, including 7 of the 10 at the top of the most admired list. So what? The real story is what was going on in the company, not the stock. In a grand sweep of allocating capital, which has been his greatest talent, Buffett completed or initiated the purchase of no fewer than 8 companies. We're not talking stocks here, though some of the lot were publicly owned, but rather entire companies. One of the acquisitions, U.S. liability of Wayne, Pennsylvania, adds to Berkshire's insurance empire. The others contribute new swatches to the Berkshire crazy quilt. Being in business as ludicrously diverse and as old economy as bricks and boots, Justin Industries of Fort Worth, and fine jewelry, the Ben Bridge chain headquartered in Seattle, and carpets, Shaw Industries of Dalton, Georgia. The purchase price, in total, was $8 billion. That's an amount dwarfed by the $22 billion in stock that Berkshire paid for reinsurer General Ray in 1998. But the $8 billion paid for the pieces of 8 was almost all cash. That's a lot of cash. More than 5 times as much, for example, as the $1.5 billion that Berkshire put some years ago into the biggest stock investment ever, American Express. None of the $8 billion, furthermore, was borrowed. Buffett just reached into the big bucket of cash equivalents he's been patiently sitting with and handed over the money. When all the acquisitions are complete, Berkshire will have more than doubled the number of its employees and added about $13 billion in revenues, although $5 billion of that, from Mid-American Energy, will not be consolidated because of regulatory restrictions. Even so, when Berkshire's 2000 revenues are reported, they ought to be close to $30 billion. This year, for the first time, Berkshire will be among the top 50 companies on the Fortune 500 list. The company's profits should be in the range of $3 billion, including significant capital gains that Berkshire realized during the year from the sale of certain stocks whose identity Buffett hasn't yet disclosed. Buffett never set out to climb into the upper reaches of the Fortune 500 list. Neither did he have some grand plan for acquisitions, other than answering the phone, he says, as he entered 2000. The truth is, when it comes to creating value for investors, he doesn't see the world the way many chief executives do. He doesn't focus on his company's stock price. On a given day, he may not know where it stands. He is not searching for synergy. He likes to buy businesses that generate healthy earnings and leave them alone. And he is a switch hitter. He has always shown a willingness to buy whole businesses or, alternatively, to buy portions of businesses in the stock market. It's just that in 2000, he went on a kind of buying binge in the whole company camp. And was he concurrently putting new capital into the stock market? No. He's been buying some junk bonds, among them Finovas, but not Consencos, even though some publications recently reported he was. He was, however, a net seller of stocks in 2000, and in each of the 4 years before as well. This retreat fits his well-known opinion that future returns from stocks can't begin to match those that investors earned in the 1980s and 90s. Among the stocks he's known to have chopped in the past few years are McDonald's and Disney. In fact, for all his renown as a stock picker, Buffett has long preferred to have Berkshire grow not by buying stocks that go up, which is what most people would assume, but by adding businesses. Yes, that can add problems too. He's had some. But he'd still rather head in that direction. The preference is emotional, in that he likes dealing with the managers of Berkshire's subsidiaries and building a real working business. And the preference is often economic as well, because of taxes. Imagine that 1. A subsidiary of Berkshire, such as See's Candies, makes $10 million after tax, and that 2. Coca-Cola simultaneously makes $125 million after tax, which would mean Berkshire's share of that, given that it owns 8% of Coke, would be $10 million. The $10 million earned by See's is totally Berkshire's. The Coke $10 million, however, is ensnared. To capture that money, Berkshire must pay additional taxes, either on Coke dividends it receives or on capital gains it realizes upon selling Coke shares. It has never sold any. If the opportunities for reinvesting capital within Coke are sufficiently good, which means that the profits belonging to Berkshire will grow, Buffett happily accepts the tax toll. But otherwise, he has no problem identifying the $10 million earned inside as what he'd like to have. He likes cash of all kinds, of course, and in Berkshire he has built a machine that produces prodigious amounts of it. The engine in the machine is the company's insurance business, which yields that wonderful thing called float. Money an insurer can invest while it's holding premiums that will eventually go to pay claims. The businesses Buffett buys with his available funds become parts of the machinery too, generating cash for further investment. As for what he buys, Buffett likes companies at sensible prices, which leaves him avoiding the auctions investment bankers run, that throw off cash and have capable, honest, and trustworthy people running them. He wants substantial earnings, for sure, but cares not at all whether they are consistent. Quote, "I'd rather have a lumpy 15% return on capital," he has often said, "than a smooth 12%. And he wants businesses that he can understand and that are not subject to major change. It is the rapid change in technology that has kept him away from tech investments. He feels that he cannot be sure how much cash flow a tech company will be producing 10 years from now, so he stays away. To get good companies at good prices, it helps to be perceived as a great owner, and Buffett has that reputation. He has piled up furniture retailers more or less by word of mouth, the first one in Omaha, the next in Utah, then Texas, then Massachusetts, then Iowa. For some sellers, Berkshire is a refuge, a place to land when, say, some members of a family that controls a private company want cash and others wish to keep running the business. To the latter, Buffett promises independence and respect, and then, barring some irreconcilable problem that just has to be dealt with, delivers on the commitment. "We don't have any MBAs running around telling these people what to do," Buffett says, and God knows I wouldn't know what to tell them. To public companies that may also have a family reason for selling, or that just want to escape the cold world of regrettable stock prices, unrealistic quarterly demands, and unfriendly suitors, he is equally a haven. These are acquisition parameters that have logic in any year. But 2000 had a tightening financial character that gave Berkshire an edge in buying companies. The money available for purchases of companies got short as the year went on, with junk bonds tough to sell and big equity investors skittish. In fact, a New York investment banker visiting Buffett told him that he thought of Berkshire as the only investor in the country that could lay out $5 billion for an equity position. There is no better example of Berkshire's edge, and of Buffett's agility in exploiting it, than the Johns Manville purchase, the 8th acquisition of the year. Manville's profile in 2000 included $2 billion in revenues from insulation and roofing products, more than $200 million in profits, and a controlling stockholder, a trust that had been set up in Manville's bankruptcy days to assume its asbestos liabilities. In mid-2000, a buyout group made a deal to acquire the company for $2.8 billion. But Manville's business later went into a cyclical slide, and the buyers ran into financing problems. They bowed out December 8, a Friday. Among those left stranded was Manville's CEO, Charles "Jerry" Henry, who had been set to participate in the buyout and was looking forward to getting divorced from the trust. Buffett and the man he's long called his partner, Berkshire's vice chairman, Charles Munger, who lives in Los Angeles, had been wishfully watching the Manville action from the wings. And 3 days later, on Monday, they called the trust and offered $2.2 billion for Manville, cash on the barrel. They had a deal, negotiated by phone, in 24 hours, and an announcement December 20th. That afternoon, Jerry Henry went before Manville's Denver employees and announced, to cheers, "There is a Santa Claus, but he's not located at the North Pole, my friends. He's in Omaha." Henry, 59, has since met with Buffett in Omaha for about 6 hours. He went into the meeting, Henry says, thinking about plans he had to retire and ready to say, "I'm gone," if he got any clue that he couldn't work with Buffett. Instead, he says, he emerged from the meeting charged up. Quote, "I came out totally committed to making this thing work. It's easy to see what happens with Buffett's companies. You end up saying you don't want to let this guy down." For this article, I talked to the heads of all 8 of the companies Berkshire bought. I heard no complaints about their new owner, just compliments. True, there's no reason these people should publicly grouse about their boss, especially to one of his friends. But it's also true that I heard stories from the sellers about money renounced, just so a Berkshire deal could be made. Ed Bridge, 44, the 4th-generation co-head of Ben Bridge Jeweler, got to thinking a couple of years ago, in a period when he was ill, that he should sell his family's much-treasured, privately owned company. He considered an IPO, or an LBO, or selling to a strategic buyer, meaning someone in a related business. But he also got a push toward Berkshire from Barnett Hellsberg of Kansas City, who'd sold his own jewelry store business to Buffett in 1995. Bridge couldn't quite see why Buffett would be interested in his relatively small company, described by Bridge as 65 doors in 11 western states. Bridge, nonetheless, talked by phone to Buffett early last year and then sent him some financial data. Back came Buffett's enthusiastic reply, recalled by Bridge as, "You guys are great, great, great." Things then moved toward a deal. But a strategic buyer heard that Bridge might be selling and began edging up to an offer. "I think," says Bridge, "that we probably could have received 20% more from this buyer than we got from Berkshire. But I also think we would have destroyed the business if we had gone that way." So in early May, he and Buffett agreed on the details of a deal, including a price not being made public. They didn't shake hands because they hadn't ever met at that point. That suited Buffett just fine. Quote, "I buy companies all the time over the phone," he told Bridge. But Bridge really wanted to see this fellow personally. He got the chance later in May, when Buffett, on his way to a Microsoft conference, stopped to do a Bridge visit. The managers and employees that he talked to that day got hours of his attention. He has great stamina when doing something he likes. They also got a dose of the usual Buffett. Bespectacled, Midwestern looks, carelessly combed gray hair, unbuttoned suit coat, suspenders, and probably the same tie he'd worn for a month straight. Plain talk dressed in metaphors. One directive Buffett gave that day is familiar to many of his companies. Just keep on doing what you're doing. We're never going to tell a 400 hitter how to change his batting stance. Bridge also recalls that, as he and Buffett drove past a See's candy store, Buffett reeled off its dollar sales. To Bridge's marveling at this feat of memory, Buffett replied, "Well, I love numbers." That made Bridge think back to what the head of a Berkshire subsidiary had warned when Bridge inquired about Buffett. Quote, "Don't show him any number you don't want him to see because he'll remember it." Buffett's buying binge naturally raises a question. How have his past acquisitions performed? Generally, they have been very successful, but not all have been unequivocal winners. General Ray, his $22 billion purchase of 1998, has slogged through a tough reinsurance market and been hurt by its own pricing mistakes. It's working its way out of those and had improved results in 2000. But some insurance analysts have argued that Buffett goofed in making this purchase. He himself mourns any deal that must be made in stock, as this one was, because he so dislikes relinquishing pieces of ownership in Berkshire. But he says he is confident Gen Re will turn into a valuable Berkshire asset. In Buffett's non-insurance companies, the manufacturers, retailers, and service companies, in other words, the profit margins generally look good, especially considering that these businesses are largely mundane. In 1999, the companies made $700 million pre-tax on $5.7 billion in revenues. After tax, their margin was around 7.7%, which was well above the Fortune 500's median of 5%. Furthermore, the managers of many Berkshire subsidiaries work under compensation agreements that encourage them to hold their use of capital to a minimum and to zip any spare dollars off to Omaha headquarters. Quote, "That's why," Buffett says, "I always come down to the office on Saturday to personally open the mail." Once the dollars get to headquarters, by the way, they don't go to paying Buffett. His Berkshire salary is $100,000 a year, and not set to rise. On the other hand, he owns 31% of Berkshire's stock, recently worth about $32 billion, so we won't feel sorry for him. In his manufacturing lineup, Buffett's biggest disappointment has been Dexter Shoe, a Maine company he bought in the early 1990s for some $440 million in stock. Encountering severe foreign competition, Dexter tried hard to stick with U.S. plants, and all it got for its pains was drastically reduced profits and then losses. Making the kind of statement he has had very little experience with, Buffett will say in his annual report that he clearly overpaid for Dexter and that he compounded the mistake by paying in stock. He will add that he does not consider Dexter's management to have been at fault. But he has had to deal occasionally with other situations in which management was patently the problem, and in which he has had to resort to firing people. Some of the problems have arisen in companies he's bought from families, in which the older, highly competent managers initially in charge do not have children with comparable abilities, which may be, he recognizes, the reason the elders decided to sell. He hit that kind of trouble at Feckheimer, a Cincinnati manufacturer of uniforms that Berkshire bought in 1986, when it was run by two brothers in their mid-60s. One brother then retired, and the other, the CEO, became ill. The CEO's son took over but couldn't cut the mustard and was ousted. Years went by with no CEO settled upon. Finally, in 1999, Buffett made a rare attempt to cross-pollinate, making a manager from one of his insurance companies, Brad Kinsler, the head of Feckheimer. Quote, "And he's just terrific," says Buffett, relievedly. "We may have to try this kind of thing more often." The vigor with which Buffett goes at fixing up his machine, or doing anything that involves Berkshire, belies his 70 years. Nonetheless, his age is a subject that often preys on the minds of the company's shareholders. Their concern is rational, given what Berkshire is. First, it is a fine collection of assets, whose value would survive Buffett's not being around. Second, it is his skill at investing the cash flow from these assets, and this talent is probably irreplaceable. The age topic got special attention last summer when Buffett underwent an operation to remove several polyps, all benign, in his colon. He recovered quickly, resumed his morning run on a treadmill, and returned to eating hamburgers, French fries snowed under by salt, and the occasional Dairy Queen sundae, all washed down by cherry cokes. Nonetheless, the operation drove the press to review what he had said in his annual report about management succession. If he were to die today, his 46-year-old son, Howard, chairman of an agricultural equipment firm in Assumption, Illinois, and also a working farmer, would become non-executive chairman of Berkshire. The sweeping job that the boss does now would be split between two people. Lewis Simpson, 64, who manages the investments of Berkshire's Geico subsidiary, would probably take over Berkshire's portfolio. The job of overseeing Berkshire's operating subsidiaries would go to some insider, whom Buffett has selected but not identified publicly. In an October article, the Wall Street Journal speculated that 3 executives in Berkshire's subsidiaries had the lead. Ajit Jain, 49, who works with Buffett in constructing big arcane insurance deals, Tony Nicely, 57, head of Geico, and Richard Santulli, 56, CEO of Executive Jet. Buffett says any one of them could do his job better than he can. Quote, but don't let that get around. He has a solution anyway. Quote, forget about splitting the stock. We're just going to split my age. The fact is that it's hard to take any discussion of successors seriously because Buffett and his doctor consider his health good, and he simply plans to keep doing his job indefinitely. He loves his work. Loves it. So does Jack Welch, of course, but GE has retirement rules, and Berkshire doesn't. Buffett sent Welch a kidding reminder of that recently after Welch, 65, made a comment to the Financial Times about age. Quote, there is nothing worse than seeing the old drooling chairman sitting in the seat. Buffett faxed that sentence to Welch with a scrawled message, Jack, we don't tolerate this sort of talk at Berkshire. I keep Charlie on stage. That would be Vice Chairman Munger, 77, on the stage at Berkshire's annual meeting. So the stockholders know it could be worse. It may seem odd to ask a 77-year-old whether he thinks his 70-year-old friend is still sharp, but that's what we did recently with the aforesaid Charlie, who is recognized as astute by all who know him. Does he see, we asked Munger, any diminution of Buffett's mental powers or ability to think outside the box? Munger first came through with a totally typical monosyllabic answer. No. Prodded to elaborate, he said the Buffett of today might just be a little better than the Buffett of all the yesterdays. Because he knows more, Munger says. Now, I've watched enough people age to know that things can happen pretty fast. Some people go along at 90 miles an hour and then, like an orange tree does, they go into a quick decline. So you can't make extrapolations, but I don't see the slightest diminution in Warren's mental powers. Munger adds that Berkshire has built up a reputational advantage. That gives you shortcuts, he says. We basically made a deal to buy John's Manville without meeting any of the people. To those who know him, it also seems that Buffett keeps coming up with fresh ideas. They don't have much to do with product innovation, unless you count his dedication to helping See's pick new lollipop flavors. But Berkshire has repeatedly dealt with its shareholders in an innovative way, giving them an owner's manual that states Berkshire's operating principles, permitting them to personally determine, based on how many shares each has, where Berkshire's charitable contributions should go, even structuring an annual meeting that permits shareholders 5 hours of opportunity to ask the bosses, Buffett and Munger, any business-related question they want. And, of course, the annual meeting in Omaha is itself unique. Around 10,000 shareholders turn up, many from abroad, for an entire weekend of festivities. A baseball game, at which Buffett throws the first pitch, usually poorly, out-of-control shopping, I hope, says Buffett, at Borsheim's, Berkshire's Omaha jewelry store, and those hours of Buffett and Munger teaching, because that's what it is. at the meeting itself. In sum, this is a company that thinks first and foremost about its shareholders. Though there may be one point on which Buffett and some of his flock disagree. Other than Buffett, I have never met a CEO who didn't think his stock was undervalued. Buffett, however, has gone through periods, one was in 1998, when Berkshire rose above $80,000, in which he felt the stock was overpriced. And he agonized about it, because he does not like to think of Berkshire shareholders as either buying or selling at prices that are significantly out of line with what he views as a zone of fairness. "I'll say this," he said recently. "I'm bothered more by Berkshire getting too high than too low." Will this heresy get him ejected from the top 10 of the most admired? For Berkshire shareholders, the fresh ideas that probably matter most are those that come out of the company's core insurance company, National Indemnity. Over the years, the insurer has built a worldwide reputation for its willingness to write a policy covering just about any risk, of almost any size, though the company always caps its exposure, if the premium is satisfactory. Figuring the odds on these policies is a joint project of Buffett and Ajit Jain, both eminently suited to the game, and the two sometimes take Berkshire into weird territory. It would require pages to discuss that terrain fully, but here's an example. Last year, they wrote a policy protecting Grab.com against having to pay a $1 billion prize, with a present value of $170 million, a lure that Grab.com used to attract millions of people to its internet site, so as to gather information about them that would be useful to marketers. The game for visitors to the site was to pick 7 numbers between 1 and 77. Bulletins warned that the odds against anybody's picking the right 7 were formidable. Nobody knew that better than Buffett and Jihan. And in fact, no one did win. But obviously somebody could have, which would have put a huge hole in Berkshire's earnings. Quote, "I wouldn't have thrown a party if we had had to pay off," says Buffett. "But we take well-judged chances like that all the time. That's what we do that almost no one else is willing to do." Jihan, whose office is in Connecticut, is someone who has actually seen a change in Buffett. In the early 90s, the two used to talk almost every night around 9, Omaha time, about the day's insurance happenings. Then Buffett started playing bridge on the internet, and that's where he normally is now at 9. Jihan says the change is okay. Quote, "We just talk now before or after the bridge game." Having frequently played bridge with Buffett both as partner and opponent, I have come to think that his bridge style, in some ways, resembles his business and investing style, though he is far harder on some of his bridge partners than on his managers. In bridge, he does not employ some of the modern bidding conventions that most players accept as standard. He knows all the odds in the game, and both bids and plays his hands with them in mind. He is analytical and focused when playing, and he keeps getting better, though he's not what bridge folk call expert. When he makes a stupid mistake, he tends to be hard on himself. "I can't believe I did that," he said recently after one hand. "That was incredible." The self-accusatory remark reminded me of something he once said about his mistakes in business. "It wouldn't matter to me that nobody else knew. I'd know." The records show there can't have been too many of those mistakes. And given continued good health, Buffett is likely to keep on burnishing the record as well. An interesting fact about Berkshire at the moment is that its 3 largest stock holdings, Coke, American Express, and Gillette, all have new CEOs. Douglas Daft at Coke, Kenneth Chenault at American Express, and James Kiltz, a Nabisco executive who was just hired at Gillette. That will give Buffett something to watch. And as he says, with relish, I've got all these wonderful companies that we own to look at. He also still has cash. Quote, "This place reminds me of Mickey Mouse as the sorcerer's apprentice in Fantasia," he says. His problem was floods of water. Ours is cash. The stuff never burns a hole in Buffett's pocket. Patience is one of his strengths. Now that he's into serial buying, though, you wouldn't want to lay odds, unless you covered yourself with a Berkshire insurance policy, that he won't strike again. A letter from Fortune's Letters column, March 26, 2001. The Value Machine is a great article, but I'd like to quibble with one point you make. Buffett isn't searching for synergy. Whether he's searching for it or not, he has an uncanny record for delivering it. Time after time, a good return on equity has become a great one under the Berkshire umbrella. Consider See's Candy, Buffalo News, Scott Fetzer, and so on. Double the return on equity of a company, and you get much more than a doubling of the company's intrinsic value. While the record for synergy is interesting, the source of that record is important. Buffett is the only conglomerator I can think of who doesn't hew to the command and control model. To that extent, he has created a new management model. Buffett is one of the greatest managers in history. He created the most successful of all the 60s conglomerates, the most successful of all the 70s inflation hedges, and he's on the verge of creating the biggest category killer of all time, a collection of category killers. He should get his due as a manager. Charles Wallman, Washington Island, Wisconsin. Warren Buffett on the stock market, December 10, 2001. A Buffett speech that Carol Loomis converted into an article. Buffett's speech at Allen & Company's 1999 Sun Valley, Idaho conclave of business leaders was so widely admired that Herbert Allen, head of the company, asked Buffett 2 years later for a reprise. Once again, I worked with Buffett to convert his speech, given in July 2001, into a Fortune article. On the opening page, we set up the piece with a question. So where do we stand now, with the stock market seeming to reflect a dismal profit outlook, an unfamiliar war, and rattled consumer confidence? Buffett's discussion, an exemplar of his out-of-the-box thinking, turns to several themes he feels deeply about: the resilience of the U.S. economy, the inability of investors, very much including pension funds, to ignore the rearview mirror, the importance of price engaging when it's time to buy. In the 2 years between his first speech and the second, indeed, the Dow Industrials had dropped from 11,194 to 9,500 as the Internet bubble deflated. Just on the basis of price, Buffett's expectations for long-term stock returns had therefore improved. But not by a lot. A chart in the article, based on a Buffett metric, showed that prices were still historically high in relation to GNP. The chart became famous. Over the years that followed, I would frequently get calls and emails asking Fortune to update it. And in fact, we ultimately did, running a new version of the chart in early 2009, when for a time it appeared that stocks would never hit bottom. CL.
The last time I tackled this subject, in 1999, I broke down the previous 34 years into two 17-year periods, which, in the sense of lean years and fat, were astonishingly symmetrical. Here's the first period. As you can see, over 17 years, the Dow gained exactly 0.1%. Dow Jones Industrial Average, December 31st, 1964, 874.12. December 31st, 1981, 875.0. And here's the second, marked by an incredible bull market that, as I laid out my thoughts, was about to end, though I didn't know that. Dow Industrials, December 31st, 1981, 875.0. December 31st, 1998, 9,181.43. Now, you couldn't explain this remarkable divergence in markets by, say, differences in the growth of gross national product. In the first period, that dismal time for the market, GNP actually grew more than twice as fast as it did in the second period. Gain in gross national product, 1964 to 1981, 373%. 1981 to 1998, 177%. So what was the explanation? I concluded that the market's contrasting moves were caused by extraordinary changes in two critical economic variables, and by a related psychological force that eventually came into play. Here I need to remind you about the definition of investing, which, though simple, is often forgotten. Investing is laying out money today to receive more money tomorrow. That gets to the first of the economic variables that affected stock prices in the two periods: interest rates. In economics, interest rates act as gravity behaves in the physical world. At all times, in all markets, in all parts of the world, the tiniest change in rates changes the value of every financial asset. You see that clearly in the fluctuating prices of bonds. But the rule applies as well to farmland, oil reserves, stocks, and every other financial asset. And the effects can be huge on values. If interest rates are, say, 13%, the present value of $1 that you're going to receive in the future from an investment is not nearly as high as the present value of $1 if rates are 4%. So here's the record on interest rates at key dates in our 34-year span. They moved dramatically up. That was bad for investors in the first half of that period, and dramatically down, a boon for investors, in the second half. Interest rates, long-term government bonds, December 31st, 1964. 4.2%. December 31st, 1981. 13.65%. December 31st, 1998. 5.09%. The other critical variable here is how many dollars investors expected to get from the companies in which they invested. During the first period, expectations fell significantly because corporate profits weren't looking good. By the early 1980s, Fed Chairman Paul Volcker's economic sledgehammer had, in fact, driven corporate profitability to a level that people hadn't seen since the 1930s. The upshot is that investors lost their confidence in the American economy. They were looking at a future they believed would be plagued by two negatives. First, they didn't see much good coming in the way of corporate profits. Second, the sky-high interest rates prevailing caused them to discount these meager profits further. These two factors working together caused stagnation in the stock market from 1964 to 1981, even though those years featured huge improvements in GNP. The business of the country grew, while investors' valuation of that business shrank. And then, the reversal of those factors created a period during which much lower GNP gains were accompanied by a bonanza for the market. First, you got a major increase in the rate of profitability. Second, you got an enormous drop in interest rates, which made that dollar of future profit that much more valuable. Both phenomena were real and powerful fuels for a major bull market. And in time, the psychological factor I mentioned was added to the equation. Speculative trading exploded, simply because of the market action that people had seen. Later, we'll look at the pathology of this dangerous and oft-recurring malady. 2 years ago, I believed the favorable fundamental trends had largely run their course. For the market to go dramatically up from where it was then would have required long-term interest rates to drop much further, which is always possible, or for there to be a major improvement in corporate profitability, which seemed, at the time, considerably less possible. If you take a look at a 50-year chart of after-tax profits as a percentage of gross domestic product, you find that the rate normally falls between 4%, that was its neighborhood in the bad year of 1981, for example, and 6.5. For the rate to go above 6.5% is rare. In the very good profit years of 1999 and 2000, the rate was under 6%, and this year it may well fall below 5%. So there you have my explanations of those two wildly different 17-year periods. The question is, how much do those periods of the past for the market say about its future? To suggest an answer, I'd like to look back over the 20th century. As you know, this was really the American century. We had the advent of autos, we had aircraft, we had radio, TV, and computers. It was an incredible period. Indeed, the per capita growth in U.S. output, measured in real dollars, that is, with no impact from inflation, was a breathtaking 702%. The century included some very tough years, of course, like the Depression years of 1929 to 1933, but a decade-by-decade look at the per capita GNP shows something remarkable. As a nation, we made relatively consistent progress throughout the century, so you might think that the economic value of the U.S., at least as measured by its securities markets, would have grown at a reasonably consistent pace as well. That's not what happened. We know from our earlier examination of the 1964 to 98 period that parallelism broke down completely in that era, but the whole century makes this point as well. At its beginning, for example, between 1900 and 1920, the country was chugging ahead, explosively expanding its use of electricity, autos, and the telephone. Yet the market barely moved, recording a 0.4% annual increase that was roughly analogous to the slim pickings between 1964 and 1981. Dow Industrials, December 31st, 1899, 66.08. December 31st, 1920, 71.95. In the next period, we had the market boom of the 20s, when the Dow jumped 430% to 381 in September 1929. Then we go 19 years, and there was the Dow at 177, half the level where it began. That's true even though the 1940s displayed by far the largest gain per capita GDP, 50%, of any 20th century decade. Following that came a 17-year period when stocks finally took off, making a great 5-to-1 gain. And then the two periods discussed at the start, stagnation until 1981, and the roaring boom that wrapped up this amazing century. To break things down another way, we had three huge secular bull markets that covered about 44 years, during which the Dow gained more than 11,000 points. And we had three periods of stagnation, covering some 56 years. During those 56 years, the country made major economic progress, and yet the Dow actually lost 292 points. How could this have happened? In a flourishing country in which people are focused on making money, how could you have had three extended and anguishing periods of stagnation that, in aggregate, leaving aside dividends, would have lost you money? The answer lies in the mistake that investors repeatedly make, the psychological force I mentioned above. People are habitually guided by the rearview mirror and, for the most part, by the vistas immediately behind them. The first part of the century offers a vivid illustration of that myopia. In the century's first 20 years, stocks normally yielded more than high-grade bonds. That relationship now seems quaint, but it was then almost axiomatic. Stocks were known to be riskier, so why buy them unless you were paid a premium? And then came along a 1924 book, slim and initially unheralded, but destined to move markets as never before, written by a man named Edgar Lawrence Smith. The book, called Common Stocks as Long-Term Investments, chronicled a study Smith had done of security price movements in the 56 years ended in 1922. Smith had started off his study with a hypothesis. Stocks would do better in times of inflation, and bonds would do better in times of deflation. It was a perfectly reasonable hypothesis. But consider the first words in the book. These studies are the record of a failure, the failure of facts to sustain a preconceived theory. Smith went on. The facts assembled, however, seem worthy of further examination. If they would not prove what we had hoped to have them prove, it seemed desirable to turn them loose and to follow them to whatever end they might lead. Now there was a smart man who did just about the hardest thing in the world to do. Charles Darwin used to say that whenever he ran into something that contradicted a conclusion he cherished, he was obliged to write the new finding down within 30 minutes. Otherwise, his mind would work to reject the discordant information, much as the body rejects transplants. Man's natural inclination is to cling to his beliefs, particularly if they are reinforced by recent experience. A flaw in our makeup that bears on what happens during secular bull markets and extended periods of stagnation. To report what Edgar Lawrence Smith discovered, I will quote a legendary thinker, John Maynard Keynes, who in 1925 reviewed the book, thereby putting it on the map. In his review, Keynes described perhaps Mr. Smith's most important point, and certainly his most novel point. Well-managed industrial companies do not, as a rule, distribute to the shareholders the whole of their earned profits. In good years, if not in all years, they retain a part of their profits and put them back in the business. Thus, there is an element of compound interest operating in favor of a sound industrial investment. It was that simple. It wasn't even news. People certainly knew that companies were not paying out 100% of their earnings, but investors hadn't thought through the implications of the point. Here, though, was this guy Smith saying, why do stocks typically outperform bonds? A major reason is that businesses retain earnings, with these going on to generate still more earnings, and dividends too. That finding ignited an unprecedented bull market. Galvanized by Smith's insight, investors piled into stocks, anticipating a double dip, their higher initial yield over bonds and growth to boot. For the American public, this new understanding was like the discovery of fire. But before long, that same public was burned. Stocks were driven to prices that first pushed down their yield to that on bonds, and ultimately drove their yield far lower. What happened then should strike readers as eerily familiar. The mere fact that share prices were rising so quickly became the main impetus for people to rush into stocks. What the few bought for the right reason in 1925, the many bought for the wrong reason in 1929. Astutely, Keynes anticipated a perversity of this kind in his 1925 review. He wrote, "It is dangerous to apply to the future inductive arguments based on past experience, unless one can distinguish the broad reasons why past experience was what it was. If you can't do that," he said, "you may fall into the trap of expecting results in the future that will materialize only if conditions are exactly the same as they were in the past." The special conditions he had in mind, of course, stemmed from the fact that Smith's study covered a half-century during which stocks generally yielded more than high-grade bonds. The colossal miscalculation that investors made in the 1920s has recurred in one form or another several times since. The public's monumental hangover from its stock binge of the 1920s lasted, as we have seen, through 1948. The country was then intrinsically far more valuable than it had been 20 years before. Dividend yields were more than double the yield on bonds, and yet stock prices were at less than half their 1929 peak. The conditions that had produced Smith's wondrous results had reappeared in spades. But rather than seeing what was in plain sight in the late 1940s, investors were transfixed by the frightening market of the early 1930s and were avoiding re-exposure to pain. Don't think for a moment that small investors are the only ones guilty of too much attention to the rearview mirror. Let's look at the behavior of professionally managed pension funds in recent decades. In 1971, this was nifty-50 time, pension managers, feeling great about the market, put more than 90% of their net cash flow into stocks, a record commitment at the time. And then, in a couple of years, the roof fell in and stocks got way cheaper. So what did the pension fund managers do? They quit buying because stocks got cheaper. Private pension funds. Percent of cash flow put into equities. 1971, 91%, record high. 1974, 13%. This is the one thing I can never understand. To refer to a personal taste of mine, I'm going to buy hamburgers the rest of my life. When hamburgers go down in price, we sing the Hallelujah chorus in the Buffett household. When hamburgers go up, we weep. For most people, it's the same way with everything in life they will be buying, except stocks. When stocks go down and you can get more for your money, people don't like them anymore. That sort of behavior is especially puzzling when engaged in by pension fund managers who, by all rights, should have the longest time horizon of any investors. These managers are not going to need the money in their funds tomorrow, not next year, not even next decade. So they have total freedom to sit back and relax. Since they are not operating with their own funds, moreover, raw greed should not distort their decisions. They should simply think about what makes the most sense. Yet they behave just like rank amateurs, getting paid, though, as if they had special expertise. In 1979, when I felt stocks were a screaming buy, I wrote in an article, "Pension fund managers continued to make investment decisions with their eyes firmly fixed on the rear-view mirror. This generals fighting the last war approach has proved costly in the past and will likely prove equally costly this time around." That's true, I said, because stocks now sell at levels that should produce long-term returns far superior to bonds. Consider the circumstances in 1972 when pension fund managers were still loading up on stocks. The Dow ended the year at 1,020, had an average book value of 625, and earned 11% on book. 6 years later, the Dow was 20% cheaper, its book value had gained nearly 40%, and it had earned 13% on book. Or, as I wrote then, stocks were demonstrably cheaper in 1978 when pension fund managers wouldn't buy them than they were in 1972 when they bought them at record rates. At the time of the article, long-term corporate bonds were yielding about 9.5%. So I asked this seemingly obvious question. Can better results be obtained over 20 years from a group of 9.5% bonds of leading American companies maturing in 1999 than from a group of Dow-type equities purchased in aggregate around book value and likely to earn in aggregate about 13% on that book value? The question answered itself. Now, if you had read that article in 1979, you would have suffered, oh, how you would have suffered, for about 3 years. I was no good then at forecasting the near-term movements of stock prices, and I'm no good now. I never have the faintest idea what the stock market is going to do in the next 6 months, or the next year, or the next 2. But I think it is very easy to see what is likely to happen over the long term. Ben Graham told us why. Though the stock market functions as a voting machine in the short run, it acts as a weighing machine in the long run. Fear and greed play important roles when votes are being cast, but they don't register on the scale. By my thinking, it was not hard to say that over a 20-year period, a 9.5% bond wasn't going to do as well as the disguised bond called the Dow that you could buy below par, that's book value, and that was earning 13% on par. Let me explain what I mean by that term I slipped in there, disguised bond. A bond, as most of you know, comes with a certain maturity and with a string of little coupons. A 6% bond, for example, pays a 3% coupon every 6 months. A stock, in contrast, is a financial instrument that has a claim on future distributions made by a given business, whether they are paid out as dividends, or to repurchase stock, or to settle up after sale or liquidation. These payments are in effect coupons. The set of owners getting them will change as shareholders come and go, but the financial outcome for the business's owners as a whole will be determined by the size and timing of these coupons. Estimating those particulars is what investment analysis is all about. Now, gauging the size of those coupons gets very difficult for individual stocks. It's easier, though, for groups of stocks. Back in 1978, as I mentioned, we had the Dow earning 13% on its average book value of $850. The 13% could only be a benchmark, not a guarantee. Still, if you'd be willing then to invest for a period of time in stocks, you were in effect buying a bond at prices that in 1979 seldom inched above par, with a principal value of $891 and a quite possible 13% coupon on the principal. How could that not be better than a 9.5% bond? From that starting point, stocks had to outperform bonds over the long term. That, incidentally, has been true during most of my business lifetime. But as Keynes would remind us, the superiority of stocks isn't inevitable. They own the advantage only when certain conditions prevail. Let me show you another point about the herd mentality among pension funds, a point perhaps accentuated by a little self-interest on the part of those who oversee the funds. Here are 4 well-known companies, typical of many others I could have selected, and the expected returns on their pension funds' assets that they used in calculating what charge, or credit, they should make annually for pensions. Expected pension fund returns. Exxon, 1975, 7%, 1978, 7.8%, 2000, 9.5%. General Electric, 1975, 6%, 1978, 7.5%, 2000, 9.5%. General Motors, 1975, 6%, 1978, 7%, 2000, 10%. IBM, 1975, 4.8%, 1978, 5.5%, 2000, 10%. Yield on long-term government bonds, 1975, 8%, 1978, 10.4%, 2000, 5.5%. Now, the higher the expectation rate that a company uses for pensions, the higher its reported earnings will be. That's just the way that pension accounting works, and I hope, for the sake of relative brevity, that you'll just take my word for it. Expectations in 1975 were modest. 7% for Exxon, 6% for GE and GM, and under 5% for IBM. The oddity of these assumptions is that investors could then buy long-term government non-callable bonds that paid 8%. In other words, these companies could have loaded up their entire portfolio with 8% no-risk bonds, but they nevertheless used lower assumptions. By 1982, they had moved up their assumptions a little bit, most to around 7%. But now you could buy long-term governments at 10.4%. You could, in fact, have locked into that yield for decades by buying so-called strips that guaranteed you a 10.4% reinvestment rate. In effect, your idiot nephew could have managed the fund and achieved returns far higher than the investment assumptions corporations were using. Why in the world would a company be assuming 7.5% when it could get nearly 10.5% on government bonds? The answer is that rearview mirror again. Investors who'd been through the collapse of the Nifty 50 in the early 1970s were still feeling the pain of the period and were out of date in their thinking about returns. They couldn't make the necessary mental adjustment. Now, fast forward to 2000, when we had long-term governments at 5.4%. And what were the four companies saying in their 2000 annual reports about expectations for their pension funds? They were using assumptions of 9.5% and even 10%.